Summit. Thank you for joining us at this bright and early hour. Our subject today is financial aftershock and the resuscitation of the flow of private capital after what has been a pretty tumultuous year in the world economy and most particularly in the banking sector. We'll be discussing the effects of the current global financial crisis and what they have done to capital flows. And in spite of the resilience that we heard about in the Indian economy yesterday, its companies are not spared concern about tighter liquidity, shortage of credit, higher capital requirements for banks, and the possibility of more regulation. We'll also try to predict future global financial shocks and what form they might come in, and what kind of threat they may pose to India's growth. And finally, we will look at steps that can be taken by financial services industry and the public sector to ensure the free flow of capital to a big emerging market like India. I'm joined by a very expert panel who I shall introduce. We have Chopra, National Executive for India for General Electric, Ashok, Chairman of MCX Stock Exchange in India, Robert Morrice, Chairman and Chief Executive, Asia Pacific of Barclays, based in Hong Kong, Jim Quigley, the Global Chief Executive of Deloitte, USA, and Kevan, the country head of Bank of America, Merrill, Lynch in India. At the end, after taking some questions from the floor, we'll conclude with some recommended actions to push forward India's growth agenda, and we'll try to identify how India can preempt global financial shocks and recommend some steps to avoid capital scarcity. A couple of final observations from me. One is that this discussion comes at a particularly interesting time for the Indian economy. India has started to tighten its monetary policy, and we heard the Prime Minister yesterday signaling that fiscal stimulus measures in this economy would be wound down next year. It also comes as the Prime Minister is prioritizing financial reforms, which are not universally popular in India. And he's included on this agenda developing long-term debt markets, a corporate bond market, strong insurance and pension sectors, and even futures markets. And he's also spoken about accelerating the disinvestment program here and selling down state stakes in companies. None of these are likely to be very easy in the current climate. But I'd like to start in the east and work my way westwards. So I'm going to ask Robert Morrice of Barclays in Hong Kong to start off and talk to us a little about how he assesses the impact of the global financial crisis over the past year and what this has done to capital flows. You just got to press the sign.
Good morning. I think the one thing that hasn't changed after the financial crisis is that India needs to attract private capital. And that's both domestic and overseas private capital. Now, we all know the most stable form of private capital is FDI. And one of the areas that international intermediaries can add value is helping channel FDI into India as we go forward. If you look at the stats now, the balance between FDI and portfolio flows is around 60-40. That's changed from around 50-50 before the financial crisis, but that may be somewhat of a short-term change because of the volatility in the marketplace. So that continued push to FDI is going to be very important. Now, if you think about how we get that FDI into the system, we talked about, I just mentioned that the foreign intermediaries can help channel that in. And as an example of how that has changed and how foreign intermediaries have helped, if you look at the time between 2000 and 2005, the FDI GDP ratio is about less than 1%. That was with GDP growing around 6%. But if you look at the periods 06 and 07, when the capital markets obviously were very strong, the global markets were very strong. And I think everyone realized that in India, the foreign intermediaries were quite involved in the growth of the market. that FDI to GDP percentage went up to around 2%, with GDP growth around 9.5%. So there were some clear links here to, as the capital markets got deeper and grew, that FDI improved in India. And I think that's a key takeaway for people. I think the other area for people as a starting point to think about with foreign institutions involved is the development of the domestic capital markets. And we all know that this is an Asia-wide problem. This is not just an India problem. But it is a bit of an arms race, for want of a better term. Everyone is trying to attract foreign capital and build out their domestic capital markets. One of the challenges in India is that 90% of debt is issued by the government. If you look at the other 10%, 50% of that is issued in offshore currencies. Again, because the underlying markets are not stable enough or deep enough to issue enough debt into the domestic markets. And that's a couple of areas. Firstly is national households in the way that people invest their capital in India and their savings. 40% goes into physical assets, i.e. gold, and with the recent central bank purchase, you could argue that people may increase that. 30% is in domestic deposits, again, with interest rates remaining fairly low, long-term returns are not very stable. And the other 30% is in what people would term as others, real estate and other types of areas. So the need to develop out different investment opportunities and diversification opportunities for the household savings in the country are very important as we go forward. So when we think about the other areas that the domestic capital market growth can help support GDP growth, I think you need to think of a couple of significant places. Firstly, it's the SMEs, which in most countries are the engine of the economy. SMEs struggle to raise capital outside of private placements and loans in India. Less than 5% of any corporate finance business goes to listed products. That needs to change and grow as we go forward. The second area is, again, an area that's similar to the rest of Asia, is growing the asset management business. And when I say the asset management business, I include that pension funds, insurance companies, for instance, as they grow those businesses. It is underdeveloped across the whole of the region, but when you look at the penetration of those investment flows, which are about 4.9% of the total investment flows in India, versus Asia ex-China, where that same data point is around 10%, you can see that India still has a lot to grow to catch up the rest of Asia as it builds out its capital markets. To conclude, though, I'd just like to raise a couple of positive points, which I think are very important to remember. I think the continuity and the stability and the push to good corporate governance in India is well recognized around the world and well received. So that's a very positive base for people to focus on. I think it's also good to remember that the legal system is stable and clear, and people recognize that. When you look at the World Bank rankings, India gets 177 out of 180 from the World Bank in terms of how it settles business issues. And I think there's a lot to be taken from that. So overall, I'd conclude my remarks by saying I think a lot is improving. I think, as James referred to just now, there are a lot of bills in Congress that will be very helpful to the growth of the domestic markets, but they need to show their commitment to keep pushing this change through. Thank you.
Robert, thank you very much. TJ, can I turn to you and ask how India can compete better in the arms race for capital that Robert mentioned?
Sure. Good morning, everybody. Before I start, what I'll do is just step back for a second and just state a few facts from where we've come from. Since the crisis started in the United States, $432 billion have been injected in most of the major banks around the world. $4.65 trillion of debt has been guaranteed by governments around the world. $30 trillion of value of shares from around the world have been knocked off, and about $11 trillion of value of homes have been knocked off. And therefore, what we also see is a significant imbalance between the United States and Asia, or Europe and Asia, because in the United States, it was an economy which was driven by consumption with huge amounts of debt, and whereas on the other extreme, you had countries like India and China with significant amounts of savings. And this imbalance can't go on for too long, and I think all of us saw it coming well, we didn't see it coming, but all of us knew that this sort of imbalance can't carry on forever. The third point I want to highlight is the fact that from a manufacturing perspective, post the crisis, we would have lost about 25 million jobs globally. In the United States, capacity right now is running at about 66% across the United States in manufacturing, which is about 13 points lower than what's normal. In Europe, the average right now is at about 70%, whereas the normal is around 80, 85, 88%. And therefore, what I want to point out is the fact that are we entering into a phase of a new normal? A new normal where there's going to be lower capital going forward, there's going to be high unemployment, debt is getting much more expensive globally, and therefore what does that mean for countries like us in India and China? I think some of the economies, like in China, have been spurring the consumption through subsidies for appliances and cars, and therefore increasing domestic consumption because of all the problems back in the United States. In countries like India, we do have, the government has actually increased domestic consumption by providing all kinds of fiscal stimuli into the economy. The National Rural Employment Scheme, the increased pay commission, the farm loan waiver to sort of increase consumption in India. But through all this, what's interesting to note is that the state-owned Indian banks have increased their market share of lending in this economy up to 74%. So it's an interesting time. What I see in this economy is the fact that there is a lot of debt in this market, but there isn't that much equity funding a lot of the bigger projects. So it's an interesting shift where there's excessive debt in this market, still at fairly attractive rates, but a shortage of equity going forward.
Kevan, can I turn to you now, please, and the view from Mumbai?
I thought you were going.
I was going geographically east.
Oh, okay.
So
You have me
we're
confused.
from Hong Kong, Delhi now.
Anyway, that's fine. Since I was at the end, I was preparing my remarks to reflect what all the other contributors had said, but I agree with both of the general comments that have already been made. I'd like to focus on, perhaps to pick up a bit of what TP is saying, because the list of reforms, of financial reforms that most people think about in terms of addressing capital needs in India are well known. Corporate bond market, development of pension funds, development insurance products, and so on. And the Prime Minister yesterday indicated a readiness to continue with that reform process. But those reforms only really deal with the medium to long-term challenges, and that doesn't mean they're not significant and they shouldn't be developed. But I think we have to recognize that I suspect the government in India and most governments in the world will have more immediate challenges in the next year to two as we deal with the consequences of the financial crisis in 2007, 2008. And so to lose sight of that at a conference like this, I think, is to delude yourself about the importance of short-term factors. As TP was saying, the quantity of money that's been pushed into the West to prop up the financial system, the shift of ownership, effective ownership from the private sector to the public sector of the excess leverage in the West is unprecedented. And I don't think any of us understand how we will extricate ourselves from this. Policymakers are openly debating different so-called exit strategies. There's also a question as to how you can exit at all from significant shifts in public ownership of liabilities in Europe, in the UK, and in the US. So I think India, the Indian governments need the imperative of keeping the Indian growth story going, the importance of keeping capital flowing in India, has to address this issue first and foremost. So the longer-term reforms should continue. They can only continue gradually, as the Prime Minister has said, so keep that on track. But worry about how you're going to deal with policy responses and system responses to the adjustment in the changing, very, very, very different environment in the West. That's clearly, I think, going to mainly affect us through foreign exchange movements. That seems to me an obvious way in which a lot of this pressure will get relieved. So the government's going to have to think about how it manages the rupee. It's got a good reserve base. Reserves have rebuilt this year. But there aren't enough reserves in the world, as we know, to protect foreign exchange rates when the market decides they're going to a different level. And I, to be honest, don't know whether capital will be flooding in or flooding out. Clearly, from a longer-term point of view, reducing the impact on the Indian equity market, in particular of foreign investors, would be good, so that we can achieve an objective in India of India financing its own investment to a greater extent. But there's plenty of savings in India for Indian investment. The question is, as Robert was saying, is getting that investment properly channeled. The last thing that I would just comment on is that in terms of dealing with this problem, Brazil has taken what many people regard as extreme action in imposing a tax on inflows. I think it's going to be interesting to see what impact that has. But I think every government in the world has to think fairly radically in the light of the pressures that are likely to emerge.
Thank you, Ashok. Are you capital flooding in or capital flooding out?
It's on. Yeah. Well, I think before I talk about whether capital is flooding in or flooding out, I think this entire debate really hinges on the fact that in the quarter of September 2008 to December 2008, there was a massive liquidity crunch. And this liquidity crunch really had its origins in what happened overseas. Basically, FIIs pulled out, the external commercial borrowings declined. In fact, they were almost non-existent in that quarter. There was a very tight monetary policy that was being followed by the Reserve Bank. This was a historical factor. They were trying to control inflation when this crisis hit India. And then, of course, there was a very old-fashioned panic amongst bankers all over the globe, and that did not exclude India. Now, as has just been pointed out, the fact of the matter is that in India, we have depended much less on foreign capital and much more on domestic savings. In fact, the domestic savings rate now, and these are the figures of 2007-8, were about 38% of GDP, which means that we have domestic savings of almost $400 billion every year. Now, the question, of course, was raised as to what we are doing with the domestic savings. I'll come to that a little later. But as I said, we have $400 billion of domestic savings every year, and this is rising. In fact, the domestic savings rate 5 years ago was only about 30%. It's now closer to 40%. And if we look at the disaggregated picture of domestic savings, one finds that bulk of it is household saving. About 65% of these domestic savings are from the household sector, about 23% from the corporate sector, and about 12% from the public sector. So therefore, the FIIs, FDI, or ECBs form a very small component of the overall pool of funds available in the country. The best year for FDI in terms of net capital inflows was 2007-8, where the net inflow was only 15.5 billion. So it's not, I'm not saying that we should completely disregard FDI or disregard FII or disregard ECBs, but the fact is that these constitute a very small segment of the overall pool of savings available in the country. Now, it's not as though, therefore, everything is hunky-dory in the financial markets in India. I think there is tremendous scope for further deepening of this market. If you look at, say, the stock markets, today there are only about 15 million demat accounts in the country. There are more than 40 million income taxpayers. So which means that quite obviously a large number of potential investors are not funneling their savings through the capital markets. There is bank credit as a percentage of GDP, again, is very low. So there are issues in the domestic capital market which need to be addressed. For instance, there was a mention just now about the bond market. It's very interesting that the bond market in India over the last 12, 13 years grew from around 21% of GDP to almost 40% of GDP. But unfortunately, most of this growth is confined to the government bond market. The corporate bond market is still only about 4% of GDP. So clearly something needs to be done to boost the corporate bond market. There are a number of things that could be done. In fact, it has been mentioned that we could be looking at a much better system of utilization of pension funds, probably deepening of the insurance penetration. Basically look at all avenues to garner long-term capital for the requirements of infrastructure. And here I think I would like to make 2 or 3 suggestions. One, of course, is that the stock markets, there is very little competition currently in the stock markets. Although on paper we have 2 national exchanges, stock exchanges, in actual practice it's only really 1, which has the major share of the market. So one needs to deepen this area also. Then there is a question of funding the small and medium enterprises. Now the small and medium enterprises are very, very pivotal to the growth of the economy in terms of employment generation, in terms of their contribution to overall manufacturing growth. And even though theoretically they can access the capital markets through the existing exchanges, in actual practice it is very difficult for them to do so because the compliance requirements, the listing requirements are very severe, and it costs a lot of money for these small enterprises to therefore access the market. So clearly there is a need for either a separate exchange for SMEs or a separate platform on existing exchanges to deal with the SMEs. And finally, I think I would like to comment a little about the central bank's policy of consolidation of existing banks. The policy has been that, I don't know whether it's a stated policy, but it is definitely a policy which is being implemented, and that is that banks need to consolidate rather than the central bank giving out licenses for new banks to come in. Now, I've always found this a very difficult argument to sustain, because even if, let's say, the largest bank in the country, the State Bank of India, were to consolidate, if all its subsidiary banks were to merge into the State Bank of India, it would still be a very, very small bank compared to global standards. So I'm not quite sure what we're trying to achieve there. And besides, the consolidation of banks would really mean that it would be more of the same. So you have the same style of functioning, the same type of businesses that are being looked after. I should think that there is a very strong case, since public sector banks account for about 68% of the total banking sector in India. There is a very strong case for more private banks to be licensed, so that they could bring in perhaps better management, better technology, so that the financial sector is further deepened. Thank you.
Thank you very much. Some very good recommendations there. Jim, can I turn to you to round us up?
Well, thank you, James. When we think about
India as a source of foreign capital or flows of foreign capital, obviously the superior GDP growth makes India a target where foreign investors would want to participate. And in a market that was characterized by excess liquidity, such as we witnessed earlier in this decade, then India becomes an important target for foreign direct investment and other capital flows into the country. And now the question becomes, if you have a market that is no longer characterized by excess liquidity, how will India then compete for that foreign capital? And while the foreign capital might be a small piece of the capital that India has been using to fuel its growth, I think to sustain that inclusive growth in the 5-year vision, multiple sources of capital will be needed in order to keep that growth engine going. And so the question then becomes, how will India compete on that stage for foreign capital? And I think if we just looked at it at its highest level, I believe that capital goes where capital is welcome, and it stays where it's well treated, just like all of us, frankly. And so how then does India then welcome capital, and how does it create that environment to continue to be a real target for foreign direct investment and have the capital needed to continue and to fuel that growth engine? And the attitude that I always take in these things is any time that regulation tries to create a market, it's going to cause that market to lag. It's going to cause that market to be difficult to function effectively. And if the market can be allowed to function and then a very healthy and a welcoming environment created, then capital will flow because of the superior GDP growth and the opportunities that are here. But if that regulatory environment, instead of being characterized by an environment of trust, that is, the foreign capital source actually wants to come for all of the right reasons rather than a investment environment that gets characterized by suspicion and therefore needs to be controlled, then it's harder for that foreign capital to flow if in fact that feels like the tone of the market is there's simply suspicion and we need to try to regulate or control or prevent abuse rather than trust that in fact this is something that is needed, that is desired, that this is contributing to what we're trying to accomplish. And we actually formed in Deloitte the Center for Cross-Border Investment because what we believe in this new environment that has been created is that capital markets are going to exist at the intersection of government, business, and finance. And you need to be able to bring those three together in order for that capital market to function. And in order for there to be opportunity at that intersection, that has to be an environment that is characterized by collaboration and cooperation rather than one of confrontation and efforts at control. And then finally, studies of FDI have indicated that the single most important driver of levels of FDI is what's really happening from a macro governance point of view. And so markets don't like uncertainty, and markets don't function well with great deals of uncertainty. So if there's a lot of uncertainty about what the tax environment is going to be, it's hard to attract capital because it's hard to model and hard to know what the return is going to be. It's hard if there's not the right kinds of actual national security. It's difficult if the government effectiveness is not in place and able to deliver on their promises, or the need for infrastructure. All of those long-term goals that have been outlined need to continue to be put in place. And then finally, the ability for the right balance in the finance structure to be there. So the references that the Prime Minister made yesterday to a bond market and the availability of long-term finance so that you can complement equity capital that flows with debt capital and long-term stable debt financings available, then that market becomes and continues to be a strong target for foreign capital to flow. And I believe the way to resuscitate foreign capital flows and the way to then compete on the global stage in a market where capital is now no longer characterized by excess liquidity, but rather a market where you have to compete, and you have to compete with other potential destinations for that capital.
Jim, thank you very much. TJ, can I pick up on something that Ashok said about whether India needed FII and FDI and whether it could survive alone on its domestic savings? And how badly does India need this, or can it go on in its domestic economy?
And that's a good question. Goldman Sachs just released a report recently which said that India can finance all its infrastructure requirements internally, given the fact that it's got a high savings rate of about 36%, and that's going to increase over time. While I do believe that the Goldman Sachs guys get it right most of the time, I don't believe that, I think, in my opinion, that India would need foreign capital to drive the growth in infrastructure investment that's required in this country in terms of FDI and FII. However, the point that I'd like to pick what Jim made, which is the fact that unless we create the right environment and the right projects for this foreign capital to come in, it's not going to come in. What I feel lacking, and when I see a lot of the infrastructure projects where we are actually supplying the equipment to these projects, there really aren't that many good infrastructure projects available. You know, on one hand, we keep talking about infrastructure, but if you really think about it, I can list the major infrastructure projects in my two hands, and that's about it. Whereas you would think in a country like ours, there'd be many, many more good infrastructure projects that require funding. So I think that's a big issue. And then another good point that Jim had made was regarding transparency, governance. I think there's lots more that we can do as a country in order to make sure that we can attract this foreign capital that's floating around.
That's quite worrying. I mean, if you say that you can only think of 2 infrastructure projects to invest in, there are $100 billion going into infrastructure in the next 3 years, according to the government. So where's that money going to go? TJ, can I ask
Or
you?
you're asking me?
Come back to you on
no,
that.
it's a good question. And that's exactly the whole dilemma we face. If you really think about it, you know, I assume consumption will increase. I assume savings will increase. But we really need to find not only to create the bond market to fund it, but the point is first create the infrastructure projects to actually that need this capital. And I think that's where that's what needs to be really accelerated, the execution of good infrastructure projects so that then the foreign capital can come in and fund it. There just aren't enough around.
Robert, can I pick you up on Jim's point of trust and light touch regulation and being friendly to foreign capital? We're in an environment where there isn't very much trust in the banking system, and there's a mood of more of regulation rather than less. How do you think India will comply in this kind of environment?
Yeah, I think, well, clearly you can say that light touch regulation didn't work very well in the Western banking markets. And somewhat that's because you have a lack of clarity in the regulatory framework about who's responsible for what within different regulatory bodies. One of the things I've always found very positive about India is that there's quite a lot of consensus around the type of policies that are put into the capital market. And when policies are sometimes enacted in the capital market without much discussion, if they quickly go wrong, they quickly get changed. And that's very unusual compared to many of the markets we deal with in Asia and globally. So I think the push globally for higher core tangible equity, for instance, in banks, is not really a problem for Indian banks. We've seen that before. The change may come with higher capital weightings for certain products. And in a market which is driven heavily by lending, that might start to make some changes to the way some banks look at their balance sheet. And I think that will be an interesting journey for some of the banks and the regulators to think through in India. And that's where I think it will be most keenly felt. And I think that's, again, what we see both in Asia and around the rest of the world is a general move from lending to capital markets products. And I think that regulatory evolution we're going through now will help spur that, and that's another reason why India will have to think about that. I think just picking on one of the points that was made earlier about the FDI, I think the question with FDI is it's not a question of need, it's a question of want. And I think with all of these economies, there's a balance required. There is tremendous liquidity in the domestic market. And if you pick up on the 1 or 2 or 3 infrastructure products and where the money's going, there's a very similar problems they have in China. There are a lot of infrastructure products, but should you really put money in all of them is the question.
Yeah. Kevan, can I turn to you and ask you about deepening capital markets and where you would start?
Can I make a different comment?
Of course.
So just drawing together some of these threads, which I think are important. I think, first of all, it's wrong to draw such a big distinction between foreign and domestic capital. I think a lot of the things that foreign capital wants, domestic capital wants as well. If you go back to the statistics that Robert laid out in terms of where domestic savings are going at the moment, where household savings in particular are going, and you would put that alongside the fact that there is actually a lot of savings in this country to finance infrastructure. The question is, why isn't that happening? Why isn't it going into that form of investment? That brings you back to the structure of the financial sector, the need to deepen the capital markets, your question, James, and also the structure of the banking system, all of which suggests that there should be further reform in the banking sector, in the capital markets. But of course, in the most recent crisis, the structure of the Indian system, exchange control, state ownership of the major banks, has proven to be a very protective measure on the short-term impact on the Indian economy. Notwithstanding the liquidity crisis that occurred, it was very minor by global standards. So I think there's the other challenge that policymakers have to address is that there are many policymakers and opinion formers in India who, it's not just a question of left and right, James, it's also a question of, well, we told you so, it did work to be conservative, to go very slowly, to have a very conservative bank system, and to proceed with capital market reforms at a very gradual level. I was encouraged by what the Prime Minister said, because it looks like he's prepared to push ahead with reform. The object of reform has to be not just to attract foreign capital, and foreign capital is important, but actually to make the financial system in India recycle Indian savings to Indian investment effectively. Foreign capital will follow that naturally, because I do believe that Indian investors are no different to foreign investors in terms of the conditionality, third-party investors, that is, in terms of the conditionality that they expect around their investment. The only real difference is that Indian investors, being closer to the investment opportunity, will be better informed about it, and maybe they don't face foreign currency risk in the same way, but we all face foreign currency risk. So this is as much about Indian savers as foreign savers. It's about taking this vast savings pool and applying it effectively, in particular to infrastructure investment. Now, in that context, to come to your question, and then I'll stop, James, there is, of course, a big focus on corporate bonds, the bond market, because bonds look like good instruments for infrastructure. Bond markets are a strange animal. They're not like equity markets. Liquidity is very different in bond markets. I don't see many markets in the world where individuals particularly invest in corporate bonds. There are mutual funds that invest in corporate bonds. A lot of bonds are bought and held to maturity. It's a very different market. So I think sometimes we really have to sit back and think about what role we want that form of debt finance to play. I actually think that you need more equity, and I think this is one of the fellow panelists made this point. Indians need to invest more determinedly on a long-term basis in the equity in their country. And that's where the foreigners have such a dramatic impact on sentiment in India. It's in the equity market, in the FII flows, the portfolio flows in and out of India drive the Sensex up and down and affect sentiment so dramatically. And that takes you back, to me, to long-term investors and obviously pension funds, insurance company type investors.
Ashok, I don't know if you would comment on that. I mean, you were previously in the finance ministry. How gradual is gradual when we talk about financial reform?
I think I think it's, I would prefer to not go as gradually as we have been going. Probably it should have been done day before yesterday. But having said that, I think these are areas which are a bit complex. And if we are looking at deepening of the market, the capital markets, we do need to do some of the things that have been mentioned by the panelists and by myself. See, here I think I would like to make a clarification that it is not my case that we do not need foreign capital. It is not my case that we do not need FDI, that we do not need FII, we do not need external commercial borrowings. My point is basically this, that we have adequate savings within the economy, domestic savings, which today we are not channelizing into productive use. If we are able to deepen the capital markets, for instance, if the stock markets were to be more developed, if more than 14 million demat accounts were to be opened, if more people came in and participated in the process of the capital markets, we would definitely have a much higher rate of growth, and we would not then be dependent on external sources of finance. The issue here really is that, see, FDI, as far as I can make out, the FDI policies of this country are as liberal, excuse me, as almost any other country. And FDIs has been, in the last few years, the quantum of FDI in the country has jumped dramatically. Of course, the outward inflows have also gone up considerably. So therefore, the net FDI, as I said, in probably the best year that we have so far, 2007-8, the net FDI, therefore, is only 15.5 billion. So essentially, my point is that we need to deepen the capital markets by a whole host of measures so that the extremely large domestic savings that we have today are better channelized into productive use.
Can I ask you as a follow-up to that? How unevenly spread is FDI across India? Because I imagine FDI goes to mainly one or two states, and a state like Bihar, I think last year attracted $600,000. That was the entire investment attracted into the state.
Yeah, actually, FDI, the flow of FDI depends a lot on the governance of the particular state. States which are well governed, like some of the southern states, the FDI inflow there is quite considerable. Some of the states on the western part of the country, where again the governance is of a much higher order, they're getting much better quality FDI. What is worrisome, and I quite agree with you, is that some states, particularly in the eastern part of the country, which have lagged behind in overall development, and it is because they have lagged behind in overall development that FDI also has been considerably less in those states.
Jim, one last question before we turn to the floor. I was very struck yesterday listening to Kalpana Moparia, the chief executive of JP Morgan in India, who described the Indian financial system as appalling. And I wonder whether you shared that opinion, and if so, how that fitted into your comments about trust and regulation and being welcoming to foreign investment.
I wouldn't have a basis for, either giving a seconding speech or disagreeing with his comments. I just simply don't know enough specifics about the Indian financial system. I just know that on a macro basis that in order for markets to function, trust and confidence is needed. And that's why I believe there's a great opportunity at the intersection of government, business, and finance. And in the new world order that we have seen emerge behind the financial crisis, the role of government has stepped up in a significant way. And that's why I think a collaborative and a cooperative environment must exist between those three players. And anytime that relationship is characterized by suspicion rather than trust, it's going to not be particularly functional.
At what point do you see that government presence rolling back a little? Are we to live with this now for another 5 years? What kind of time horizon?
Well, I think the I'm hoping that we're going to see the government able to step back from the stimulus activity that is engaged in, and the Prime Minister said yesterday that was his intent, at the appropriate moment. But we need to have private demand return so that, public sector demand doesn't have to replace the fundamental engine to try to keep the economy moving. And we also, and especially characterizing the United States, I would like to see the government be able to step back from some of the intervention that has been required to put trust into some of those markets, and therefore significant capital injections into both some of the financial institutions as well as some of the industrial enterprises. We need to find a way for government to work their way back out of that position, but they were required to step into that role because confidence had gone out and the markets stopped functioning.
TJ, you want to come in?
But the only point I would make is the fact that it's a good question as to when the governments are going to roll back all the stimulus package that they've given, because I think at some point in time, the fear for all of us is going to be, is there going to be another asset bubble being created because of all this liquidity that's put out? Now, I'm not saying each country will have to decide when that right time is. And, maybe countries like in India and China, the rollback would happen much, much quicker than the United States or in Europe. And Europe might take much, much longer given the amount of money that would still need to be pumped into some of the banks in Europe. So that's my only point that I wanted to make, was the fear of an asset bubble is something that we should track very carefully.
Kevan.
It's clearly the asset bubble is one issue. The other issue is what exactly has happened to the indebtedness in the West, and all that's happened fundamentally is a shift from sort of household bank balance sheets to government balance sheets. And to me, particularly when you look at the structure of most Western economies, certainly the UK, Europe, and the US, consumption is such a critical driver of these economies. So those economies are not going to grow very fast for a very long time, in my view. When you cut through all the discussion about exit strategies, how can they grow very fast? I mean, yesterday I heard a figure of sort of 1.5% real growth. I think that's kind of what we're in for a period, and probably quite a long period. So coming back to this discussion, I think where I part a little with Jim Quigley here is that actually I don't think India is going to have to compete very hard for foreign investment, because India is going to look so good against this growth backdrop at the GDP level that India is going to be even more of a magnet for foreign capital. That doesn't mean it will just keep coming, because all the reform issues that will need to continue. There are things Indians could do to stop that. But actually the policy of the government, as enunciated by the Prime Minister yesterday, is to continue progressive financial reform. That's just going to attract foreign investment. I don't see, I mean, I've worked all over the world for Merrill Lynch in my 29 years. There is a reason why I'm now working in India.
I think there's no question that superior GDP growth will attract capital. There's no debate about that. The question is, if you have many markets that enjoy superior growth, where is the capital going to go? And the only point I was trying to make is the regulatory environment that is friendly and receiving to that investment is going to do better than one that perhaps has a great deal of suspicion characterizing how that regulator is behaving and how it's ready to welcome capital. And so where capital becomes more scarce and you have multiple emerging markets with projected superior GDP growth, where is that capital going to flow? And that's the only point I was trying to make. There's no question that a market of this scale with superior projected GDP growth is going to be an attractive destination for foreign capital.
I think it's time to bring in some questions from the floor. So could we, gentlemen just there, have we got a mic? In the second row. Here it comes. Terrific. Please introduce who you are.
Myself, I'm Anand Bajaj from Bajaj Electricals. The question is really more about the report which came recently from the government that they're planning to, basically for the public sector units to be publicly quoted to unlock value. Now, such moves from the government, do you think it's going to be positive in terms of for your FDI and other, India basically becoming a better destination? Because essentially they are trying to unlock value from profitable public sector units, which was a big news in the market. Your views?
Ashok, do you want to take that? A question about disinvestment and the move last week to...
I think you're probably referring to
flood states.
the process of disinvestment that the government has planned to do of all profitable public sector enterprises. Well, this is going to add to the amount of money available for the government. The first impact of this obviously will be that the fiscal deficit, which today is a very high number, it's projected to be 6.8% of the GDP, that will decline substantially as a result of this. The other aspect of this is, as the government announced recently, that this money will be used to fund a lot of social sector projects. So, projects in the education and health and so on. These funds will be utilized for that. So, to that extent, it is going to be a very, very beneficial aspect of the reform process.
The gentleman three down. Yeah.
My name is Rupen Roy, and I'm from Deloitte, and my question is directed to Mr. Jha. Now, we are looking at FDI as one of the multiple sources of capital, but FDI brings in something more than money. If you look at the Suzuki investment in Maruti Suzuki, it actually shook up the car industry. It brings in better market access, it brings in manufacturing processes. So from that point of view, don't you think FDI has got a special role in terms of contributing to the development of the country?
No, I entirely agree with you. That's why I hasten to clarify that I was not saying that we do not need FDI. The fact that FDI brings in not only money, but it brings in maybe technology, it brings in maybe better forms of management, it probably brings in greater transparency, better governance. These are issues which cannot be, shoved under the carpet. The basic point that I was referring to was numbers in terms of money, because as I said, the best year that we had so far in FDI, net, I'm not looking at the gross figures, was 15.5 billion. And compare that with your own savings that you generate in the domestic sector of about 400 billion. It's not such a sizable number, but I quite agree with you that FDI brings in other factors also along with the money.
TJ.
The only point I would make is the fact that it's absolutely essential that we do get FDI in manufacturing. It's something we have to do. Over the next 10 years in our country, there are going to be 300 million people coming into the workforce. These 300 million people, it's going to be difficult to absorb them into the services sector, given the fact that that's slowing down. Agricultural sector is going to be, there's only so much that the agricultural sector can absorb. And therefore, we have to grow manufacturing in this country to absorb 300 million people. And therefore, it's critical that we continue to attract FDI and core manufacturing to grow this economy to absorb all these people.
Gentleman at the back by the cameras.
Morning. I'm Sunan Sharma, country president for Alstom in India, and particularly to Mr. Jha with his vast experience in administration in the government. What I've heard generally is that there's no shortage of money, there's no shortage of destination for the money, and yet I come out of the last 7 or 8 months of experience where after 2 or 3 years of effort, an entire $12 billion worth of potentiality in ordering of locomotives by the country of India collapsed on account of just a few commercial terms and conditions not being sorted out within the administration, inter se, between the Planning Commission, the Railway Ministry, and the Finance Ministry. I don't think it is any of the aforesaid things which matter. I think it's all about clogged pipes. And the discussion between people to sort out these minutiae so that we can just get on with the job of doing what we're here for. I'd like your response, Mr. Jha, about unclogging these administrative pipes.
So this, of course, is a different kettle of fish altogether. But anyway, I will respond to your concern. See, there is absolutely no doubt that what is very important today in the country is implementation. It's not really just having the projects. As I think TP also mentioned earlier, of course, he said that there are very few projects in the infrastructure sector. I think there are a number of projects. In fact, yesterday Mr. Kamalnath mentioned that the requirement of funding for just the road sector is about 20 billion. One of the studies, this is per year, $20 billion per year. One of the studies that has recently come out talks about $60 billion of funding required for the energy sector in this country. So the requirements of money are there. The money is available, but I agree with you that what is very important is the implementation of the projects. Implementation in terms of also government rules, regulations, governance, and so on. And that is why FDI has been flowing into those states where the quality of governance is superior. So I'm sorry to hear that you had a bad experience. I'm sure that, but there are, let me also say that there are many, many people who have profited by investing in the country. Again, to get back to some of the earlier studies have shown that, yes, there have been bottlenecks in people being able to invest money in the country, but once they have invested, the return on that capital has been far superior than that to returns in other countries.
On the far side there, just under the boom, the man with his hand up, please.
I'm Hemant Mishra from Standard Chartered. There's been a lot of concern globally on the speculative effect of foreign capital. What the Brazilian government's done in terms of levying the tax as one such measure. It's interesting that Gordon Brown set up a task force to look at how the speculative nature of capital can be managed. What does the panel think would be the impact of any of these measures?
Would you like to say that? Robert?
Well, I think you have to take a step back and look at regulation in the UK slightly different to the rest of the world at the moment, as we are running into a UK election. So there are a number of proposals being floated that are probably more aggressive than they would be in a normal time. There is no doubt that if you make radical changes to the accounting treatment of certain instruments within the capital markets, it will have dramatic effects on the cost of credit in the banking system. And that is not from, that's just a truism. It is a fact. If you look at the amount of capital the banks are required to hold on their balance sheet right now, returns clearly in banks' equity has gone down significantly. But if you look at also in terms of the amount of liquidity that banks need to hand, in terms of liquid assets on their balance sheet, that is another cost to the bank. So at the moment what you have is a situation where costs to banks are being loaded up in hidden measures as the regulatory environment becomes much tougher. Now, what that basically means is that the cost of credit has to go up. And the cost of credit has to go up to people in the retail sector, the corporate sector, many other sectors. So the more you ramp up regulation at this stage, which is why it's actually better to wait until we're through this before we change the regulation and avoid the unintended consequences. But the more we ramp up the regulation on credit at this stage and the capital requirements on that credit, the more expensive credit is going to be available globally.
So the man towards the back.
My name is Arun Duggal from Shriram Capital. It's been a very interesting discussion. A little bit of confusion in the beginning about desirability of FDI, but Mr. Jha clarified that. I have a suggestion. Rather than look at gross FDI flows or net FDI flows, and as it was mentioned that the net FDI flows of $15 billion was not a very large number. my suggestion is rather than look at that number or gross FDI flows coming into the country, what truly is becoming important is what is the sum total of FDI coming into the country and the investments Indian businessmen are making for the long term outside country. So if you combine these two numbers, I think that would be a good indication of how quickly, how far Indian economy is globalizing. And I think that is far more important in today's context than just the flow of capital into the country.
Robert.
I think that's a very good point, actually. If you look at the 1990s, foreign assets and liabilities made up 40% of GDP in India. If you look at it now, it's 60%. And this is purely down to the success of Indian corporates and investing overseas. And if we truly believe in the growth of India, that is going to continue. So I think it's fair you have to break these apart. You can't just look at net or gross, you have to look at the flows in and out. And that will lead to further challenges and further constraints on the capital markets. So if Indian companies are not to be constrained going overseas and becoming ever more acquisitive, a lot of these proposals we've been talked about need to be forced through the system over the next 5 years.
Back to the front, the lady in the second row, please. No,
Morning, gentlemen. My name is...
The lady just behind you.
She wants me to...
Oh, she wants you to ask it.
If we were to poll this panel on post-slump, is there a stronger case for decoupling, or is there a stronger case for integration of the world economies? If I were to invest domestic resources into taking the Indian growth forward, I would in a way be putting a lot of store by decoupling of my economy. But so after the slump, do you think more countries will be more protectionist, and is that the way forward?
Jim.
You know, I think that there's no question that there are protectionist trends that have crept into the stimulus packages in the spirit of committing public money and then feeling that that has to be done to try to preserve jobs in the local economy. I'm embarrassed by the Buy American phrase included in the U.S. stimulus bill. All that did was lead to other buy national kind of phrases into those stimulus bills, and that is absolutely not in the best interest of economic recovery, and protectionist measures are just simply going to lengthen the time that is needed to get to a recovery. And I believe that the decoupling theories all went out the window in the last 12 months when we witnessed how interconnected our global economy has become. The discussions in Davos in February of 2008 were all along the tone of there's a made in America problem that's going to stay in America because the global economy has decoupled from the U.S. economy because of the diversification of the global economy. That was the fundamental thesis that you heard over and over again. And then what we watched play out in the ensuing 12 months was instead of a decoupling, we have an incredibly interconnected and an incredibly interdependent economy. And I believe that the global economy is actually better off if, in fact, we have free flow of trade and free flow of capital. And protectionist measures are just simply put aside or called out and shamed and driven out of the system, because otherwise it's going to take us a decade to recover rather than 1 or 2 years to recover, in my view.
Can I take a question from the left and then the man in the front?
Yeah, Martin Hamick from Sentiment Stanford. We talk about private capital and flows. If we look at who is going to finance what I call innovation for future growth, we all talk about infrastructure, we talk about whatever has been discussed, but no one, given the discussion yesterday by, I call it the big boys, who is going to finance? Is the private sector going to finance? Is the capital flows from, I call it foreign ventures, investors, which is very marginal actually, in fact, in India. and has just retracted by 70% over the last 6 months. Where is that coming from? The growth through financing innovation, where is that coming from in India? Looking at future growth.
TP, can I ask you to answer that? Financing innovation.
Well, I can share with you our example. We now have 5,500 PhDs and engineers doing pure research for GE worldwide in energy and oil and gas and water and aviation, rail, healthcare. So we are one of those companies that have realized the potential of human capital in India and therefore have made significant investments into India. Our labs in Bangalore, we've invested over $120 million over the last 10 years, and we've made significant investments in India. I think increasingly, Indian corporates as well are now realizing the benefits of investing in R&D. The auto sector is a good example where there's more investments into innovation coming up as well. I think over a period of time, other Indian corporates in other industries as well will significantly increase investments in innovation as well.
Gentleman at the front. I think that's our last question, and then if we then just have a quick sum up from the panel and then close the session.
My name is Mathur Bajaj from Bajaj Auto. A lot of countries have been forwarding stimulus packages. My question to the expert panel is, how do you calculate the time lag between introducing a stimulus package and its impact so that one can decide when to stop, as the Prime Minister hinted yesterday, because the earlier stimulus packages would carry on for that much time, which the panel thinks, how does one go about calculating? Thank you.
Ashok, can I give that to you and then ask Kevan to comment?
I don't think there's any precise formula by which you could do this calculation. But, for instance, if you look at the Indian example, the stimulus packages that were launched by the government in December and twice in December and I think once in February. The impact of this in say, the automobile sector itself, which you said you represent, was enormous. Because if I recall, in November 2008, the automobile manufacturers were projecting a contraction of 3 to 5%. Today, they're looking at a growth of 12% plus. So that's been the kind of change. Then if you look at, let's say, China, one of the recent reports suggests that the first 6 months growth in China in 2009, 88% has been because of investment, and most of that investment has come in from the government. So the impact of the stimulus packages have been huge, but when it starts kicking in and when it stops, I don't think there is a formula for that.
The point I used to work at the British Treasury, so I was a government official dealing with these kinds of issues a long time ago at the beginning of my career. And the fact was we didn't know where we were on any day, so you didn't know what you were doing and where you would be tomorrow. And that's just a fact of trying to run government finances. I'm sure you'd agree, sir. The data is late. It's 6 weeks ago, 4 weeks ago, and so on. So it's pretty challenging. But the point I'd like to reiterate is a point that I made in my introductory comments, is that when you look at the stimulus packages around the world, when you look at the measures that have been taken to prop up the financial system around the world, we are in unprecedented territory here. And to come to the question of the lady behind you, the world is not decoupled, it's very interlinked, and there's no right or wrong about it. That's how it is, and it's not going to change. In my view, protectionist measures will not change that, and hopefully they won't be introduced, but it's the interconnection of the world is far too... the only thing that could derail it now is a major political crisis, a major war that divided the world on political grounds. Absent that, it's a very interconnected world. So that is the challenge facing finance ministries and central banks all around the world, is how do they measure their own stimulus? How sustainable is the recovery that they've seen? how interconnected is it with the measures taken in the US or in China or elsewhere? How do we have a coordinated response of exiting, and what will happen when we withdraw this support? If you look at a country like China, the amount of state support has been phenomenal in relation to the growth rate, as Mr. Jha has just said. So will the Chinese economy continue to produce the 9% growth that its policymakers believe it needs in the absence of that support? These are very unprecedented questions, just in the scale and the interconnectedness around the world.
We've come to the end of our session. If I can just ask the panelists to conclude with an identification of what they would think is the single most important factor to push India's growth agenda forward. Just one action that could be taken either by the government or the private sector, or indeed by the global economy. If I could start with Robert and just come straight across the line.
I think the insurance bill will be the start of really helping the domestic capital markets, the asset management area grow. I think that's very important to set the tone for what happens next.
I'd say just keep pushing infrastructure. Once we get our infrastructure right, a lot of other FDI and investments will follow. So I would say really push infrastructure hard.
Jim.
Continue to liberalize the policies related to investment, include retail in those automatic approvals to attract investment.
I would think that to make better use of the domestic savings, we need to deepen the stock markets, bring in greater competition, have a separate platform perhaps for SME trading.
Okay.
I think I would go more along with Ashok here in terms of focusing on improving the intermediation of domestic savings into domestic investment. FDI is important, foreigners are important, but let's get the domestic intermediation better.
Some excellent suggestions. Thank you very much for joining us, and thank you to our expert panelists for their thoughts.